I feel like I
Morning.
tripled today. I went to
Yeah.
jiu-jitsu for the first time in 2 months, and I think I got beaten by 2x4s. My age is showing.
Yeah, I hear you, man. It's creeping up. I don't bounce back nearly as quickly as I used to.
Yeah, well, there's all the people watching that are in their 40s or 50s, like, you kids, you don't even know yet.
Youths.
But I wanted to
What's
dive
up?
into something today, and I
What's
think
up?
there's a major misconception in the real estate investing community, and I think that we are at fault.
Okay.
And by we, I mean the professionals in the real estate investing world. And that is, you need 10, 15, 20, 30 properties. How many doors do you own? I need 100 doors by X day. And I think it's a combination of when people get into the real estate investing world, it is very social and very friendly, but there's a competition edge, right?
Yeah.
Especially the real estate investing groups. And I think that this is something they need to get away from. The person who takes the most action gets the most recognition. There's no consideration for their risk tolerance, what level of crazy are they taking on to achieve this. It's just the person who buys 10 properties generally gets more recognition than the guy who did one.
Yeah.
And I want to talk about this because I think it's a major mistake. I think it's bad for the long-term health of our community. And I also really don't think it's something that you and I believe in. So I want to unpack it, and I want to dispel this myth that 100 doors or 1,000 doors is better
Hmm.
because more money, more problems. I think the same is true to a degree of real estate, especially when your quality control starts to be compromised.
Yeah, exactly. I find it interesting because you hit, this is an interesting topic. I mean, even in the investing groups that I'm a part of, they do very much celebrate the folks that have bought more and more and more properties. Like one of them even gives out little badges. When you have a certain number of properties, you're a bronze or a silver or a gold or a platinum, and you got your little badge says I got 50, 60, 70 doors. So it's definitely, there's a got to catch them all kind of
Because
mentality to it.
here's the issue is that real estate investing is presented to most of us as a way to create financial independence and to essentially break free from our careers.
Yeah.
But that's the messaging, and that's usually what gets most of us in the idea of passive income for retirement or to help our kids or work less.
Hmm.
But then the actual implementations presented like real estate like a career.
Yeah.
Like, and there's nothing wrong with being a full-time real estate investor and having that as your job. But to have the 50/50 property club badge, that's generally going into the job level commitment to real estate. And to
Hmm.
do that in any degree of a reasonable time requires almost a full-time effort. So it's kind of interesting that the advertising is one thing that gets everybody in, but then the actual implementation very quickly pulls to real estate being a full-time job, raising capital, doing developments, like just there's no. I'm a believer of what is the minimum you can do risk-wise, energy-wise, money-wise to reach your goals in a minimum amount of time that's acceptable to you.
Hmm.
To me, that's the question. And if Jordan Spitters needs to do 5 properties in 10 years to reach his goals in 15 years, great. But there's not a lot of energy into figuring out what that is. It's just real estate investing is great. Hoorah! And then it's buy as many as you can, as quick as you
Yeah.
can.
Well, and then you get these golden handcuffs, right? You got into this to try and give yourself financial freedom, and then you're all of a sudden you're a slave to this hunt for more properties. I
100%.
completely agree.
It's
Yeah.
we're on the same page with Chris too, who's pretty involved with the Alberta market
Yeah,
on that.
absolutely. You know, it's they kind of have conflicting ideals because a lot of the time, you hear this idea of finding your Belize or building your portfolio so that you can retire, and they do. You're right. They kind of pull people in with this idea that it's individualized, it's your retirement plan, and then it kind of shifts to just like buy, buy, buy. Did you buy a house this month? Did you buy a house this year? Right? And
Huh.
it is.
Wonder if
It
they
is.
make money when you buy a house. I wonder.
Yeah, so I mean, it is. It's a pretty high pressure scenario. But look, most of my clients are going to be one, maybe two. In the odd case, it's going to be three or more. And it's not once every 6 months or once every year. It's once, and then maybe I'll connect with them again in three or four. So
Cool.
the yes, there are the folks that are like driving. and they get one or two every month, and they're just, massively building his portfolio, and they're engaging with dozens of people to do joint ventures. But you're right, that's a full-time job, and most people just can't handle
For
that.
everyone watching, I want to promise I've actually prepared some numbers that we're going to jump into in a minute, but I just want to continue on this thought a little bit before we dive into the numbers. Have you not felt, and for those of you watching, I'm sure you felt this. I deal with clients regularly who feel like they're failing because they
Mm,
only bought one property this year. They only bought two properties in the last 3 years. Think about it. You're in the top 1% of Canada.
yeah,
Almost no one in Canada, if you look at the masses, will buy two properties in their lifetime at the same time, unless
yeah,
one's being sold 2 weeks later. And yet, the clients I work with in these real estate investing groups are coming to me like upset, sad, disappointed in themselves because they only bought one, two, five in the last however many years. Like I even have one client who's beaten himself up and he's done three this year in Edmonton. And oh, but I really want to do four. And I'm like, dude, you're crazy. Like
yeah.
go crack champagne, go for a nice dinner.
You're in
But
the
do
top
you come across that
1%.
too?
You're in the top less than 1% to have more than, three or four properties. We're talking half percentile here. Very, very few Canadian. I mean, I think it's less than 4% of Canadians even have a second home in the first place. If you're within that very small group, you're already so much further ahead than most people in this country. You're taking those steps. Everyone has a different path, and yeah, this idea that you need to drive hard and constantly be buying just to buy is unhealthy.
No, I think you got to think of it like a business perspective too. Let's
Yeah.
just say that you're trying to start up a little business and then your neighbor does the exact same business in a different city. Well, if you start up slowly and you work the shop and then you eventually get an employee and you gradually expand and then you open up your second location, it took you 3 years, but you did it consistently and safely. Is that worse than the person who goes and leverages everything, gets a high interest loan, borrows money off his parents, and hires 32 staff day one, opens five locations? I would argue, at least personally, and maybe this is kind of my more conservative nature when it comes to risk, but I prefer the slower scenario
Hmm.
because you know that if you hit issues or turbulence, you can dial back, you can solve the problems.
Yeah.
The person who goes full leverage, full expansion will maybe be a multimillionaire in 5 years, or
If they don't
most
hit any
likely
road
be
bumps.
bankrupt.
Yeah. I mean,
So
when you're leveraging yourself that hard and you're just teetering on the edge and there's only one or two things could push you off. I mean, that level of stress, hey, it works for people. There's people that have had great success doing that, but most folks don't want that level of stress. And I come from farming. My family, we're chicken farmers. For the longest time, every dollar that my father made, he put back into his small farm, paying off his debt, buying a little bit more quota, building up equity. And then eventually he started buying more farms, buying more businesses and expanding. But it took him 25
but
years
let
before
me
he
ask
did
you
that.
this because I don't want to dive into the personal, but did your dad go from a relatively normal person with relatively normal success to an extremely successful person?
His business grew pretty exponentially over the last, 5 years. It's quite large now, but it took 25 years before he was felt comfortable and stable enough to be able to make those expansive jumps. Until that point, he was just, very metered and focused on building up and supporting his core business first. And then from there, once he had that stable platform, then expanded outwards. But he wouldn't make moves if he didn't feel that it was if there wasn't a level of security there to it. It's not to say that he was completely risk averse, but definitely a very conservative approach
Kind
to
of followed
his.
a slow as steady, steady as fast type
Yeah,
approach.
he always described it as, pushing a boulder up a hill. Eventually, you will reach the top of that hill, and it will start to accelerate on its own back down, right on the other side, and that's when things really, really start to pick up. Some people they try just to throw the boulder over, and it comes back down rolling in their face. You have to be really metered, slow pushes, and then you hit the top, and it rolls over. It is the way it was always kind of described to me, and I like that analogy. That's very much how he always functioned, and I take the same approach with my real estate investing. I want to buy as many properties as I can. I'm constantly looking at properties every day for clients and going, oh, is that a good buy? Is that a good deal? I offer them to my clients. If they don't want them, then I consider them for myself. So I'm always being tempted, but I try to take that slow, metered approach. Right? If something goes wrong, what happens if they're down in the market? And I don't want to over leverage myself simply so that I can get that silver badge. It's not worth it.
So I want to be real with everyone watching. If you come to me and you tell me that you want to make $150,000 of passive income in 4 years, I can't help you as a mortgage broker. If you go raise capital and you do some crazy Wayne Gretzky level efforts, you can absolutely do it. There's a couple dozen people in the industry that have done it, but the average person isn't. But what I can show you is a way that you can make about $220,000 of passive income after expenses in 25 years. And it consists pretty simple. You buy 5 properties. So I'm going to use baseline numbers. It's going to vary market to market, but if you buy a $500,000 rental property, which it could be a condo or maybe a very small townhouse in Abbotsford, it could be a suited house or a triplex in Edmonton, it could be a house in Calgary. There's at the 500K price point, there are markets across Canada where there's something there. And in some cases, maybe you'll buy 4 properties at 800,000 instead of 5 at 500,000. But at the end of the day, over a 10 to 15 year window, if you buy 5 $500,000 properties, that's going to need $100,000 in down payment per property. And it's important to know that if you own your own home, you can use the equity in your home to buy the next one. And you can also use the equity you're building in each of your rentals, kind of like batteries in a cell. The more you have, the more momentum or charge you're going to get. But over 25 to 30 years, if you buy these 5 properties, odds are they're going to be paid off in that 25 to 30 year window, because as soon as the first one gets paid off, all of a sudden you've got a huge jump in cash flow. So you can use that to start hammering down the next property and the next one. In 25 to 30 years, odds are the value of these properties, roughly speaking, is going to double. So now your 5 times 500,000 is 2.5 million, doubled over the 30 years is roughly $5 million in asset value you've fully paid off. Assuming these properties rent for $3,000 a piece, that works out to $180,000 a year today. Obviously, there's mortgages. Maybe your cash flow is zero today. But in 25 to 30 years, odds are the rents are going to double. It's going to be about $360,000 of gross revenue. Then you're going to have property taxes, maintenance, vacancy, property management. There'll be other costs. I quickly ran numbers with Jordan, getting a second opinion from him. We use 33%. That's about $220,000 of income for your family to retire. Hey, maybe it's 50%. That's $180,000 of passive income. Hey, maybe rents went up less than you expected. Maybe it's 100,000. I don't know. The point is that with $500,000 over a period of time, if you just buy, and maybe it's not 5, maybe it's 2, maybe it's 3, I don't know. But I'm a believer of using real estate as a pension fund. You buy 1, 2, 5 properties, whatever it may be, slowly, safely, consistently, and you target longevity and quality over cash flow, over instant gratification, over, oh, I got a 4-plex. It's amazing. Well, I own 2, and I can tell you they're a pain in the ass. But if you do this slowly and consistently, I am certain you will have far, far better success than the person who's running down the hill and hoping that they get to the bottom before they collapse. Because it's important, and this is my personal opinion, but much of the Canadian real estate investing culture is influenced by the US real estate investing culture. Bigger pockets, there's dozens of groups, a lot of the information spills over, but they have a very different system and financial culture than we do. The idea of going bankrupt, no big deal in the States. Like, if you don't believe me, and I'm not going to get political, look up Donald Trump and look at how many projects have gone bankrupt. Not saying good or bad, simply saying that it is totally acceptable to have projects go bankrupt and for people to lose money. It's just part of the culture of capitalism. A lot of these strategies have the idea that if you're 23 and you get into real estate investing, you go hard, you take all the risks. If you go bankrupt, oh well, you learned from it, you made some connections, you'll reset in your early 30s. Try again, go harder, take the mistakes you made, try again. If you go bankrupt, oh, well, you're going to reset in your early 50s this time. There's no way you'll screw up the third time. Go hard, do it, build your retirement. With the idea that if you make it the first time, you're now a millionaire in your 30. If you succeed in your second time, you're a millionaire in your 40s. Just don't screw up the third time. But I can't speak for you guys. I can't speak for Jordan, but I could never sleep at night doing that. I certainly couldn't sleep at night encouraging clients to take on that level of risk, because many of us forget the mental side, the stress, our family. And I have no interest in borrowing money off my neighbors, my friends, and my family so I can go try this. So I wanted to take the time with Jordan to least share my side. And you may not agree with me on everything, Jordan, but
No, I
really
think on this one we're on the
slow
same
down,
page.
everyone.
Yeah, this one we're absolutely on the same page. You got to run your own race. And, even if you're part of these high pressure groups, don't let peer pressure lead you into believing that you need to further extend yourself or overextend yourself just to impress the group with another property that you've got into. If it's not a great property and you're just ticking off boxes, it's not worth it. So yeah, figure out your own necessary purchasing plan and have a long-term strategy that you follow. Otherwise, you just get caught up in FOMO and then you make bad decisions, and there's never any good that comes of that.
And you got to think of it logically. If you join a group, a coaching program, any type of real estate thing that charges a reasonable amount of money to be a part of it, which most do. There's one that I always like to pick on. I won't name names. That's actually relatively cheap, a couple $100 a month. And they're actually at the top of my list, not because I think they're the best, but because they're fair. They're not trying to get $50,000 a year out of you or whatever
Yeah.
some of these groups charge. But if you're spending money, let's just call it 10 grand a year, you need to do a certain amount of action to get the value that you keep paying.
Mm-hmm.
Many of these groups monetize the professionals they work with. So whenever you do a transaction with the professionals, money trickles back to the group. Some don't. I'm not trying to say they're all like this, but there's an incentive to create a culture that's buy, 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 buy.
Yeah,
And
absolutely.
if they teach you the fundamentals and you're like, okay, I get the fundamentals of real estate investing now, and I'm going to buy one property every 4 years and I'm going to end up with three, and it's going to build a complement to my pension and my other savings. That's probably the best case scenario for most Canadians, but it's the worst case scenario for any group that's trying to get you to consistently pay and is monetizing all the transactions you make. And I'm not saying they're all bad. There's lots of good real estate investing groups, lots of good coaching programs, but they're probably not all great.
No.
And they're all going to have different degrees of trying to help people in business. And everybody's going to fall somewhere in the middle. So I figured I would risk getting torched by some of these groups that I believe the only ones that'll get pissed off are the ones that are really on the far end of the spectrum. But
Mhm.
just wanted to share with everyone to think for
Oh,
yourself, slow down, and be proud of what you're doing.
I'll throw a little bit of gasoline on that torch fire there and say that, look, if you're about to spend 20, 30, $40,000 on some investment informational group, just give us a call because we can give you that information for free.
Usually it's, oh yeah, great plan. Yeah, yeah, a little coaching. And then, okay, you're going to call these professionals anyways.
Yeah, exactly.
Kind
So
of
just
funny.
skip the big bill and just call us. It's easier.
I stand by. If you're going to spend 10 grand on coaching, instead spend $10,000 on taking influential people in the industry out for dinner or
Yeah,
coffee. Or
absolutely.
think
Belly to
about it, you could
belly
spend
with some
5,000
leaders.
for your time to skip work one day a month or whatever, and then go like find developers, construction people, mortgage brokers, real estate lawyers, like other investors. Prepare 8 to 10 questions. Like, what advice would you give yourself if you were just getting in real estate investing? What's the biggest mistake you ever made? What's the one thing you wish you did differently? Whatever your questions are. And go have your meet network. Hey, Jordan, I really appreciate you coming out for dinner. If you don't mind, I'm just going to take a couple notes because I'm here to learn. I'm not here to get any favors from you. I just want to get an understanding of who you are in the real estate investing world and your perspective. So hopefully I can be a better investor. And take notes, ask questions, go home, log it in your little system. At the end of that year, you're going to have met 200-300 really well connected people who are probably going to be like, holy shit, no one does that. This person's going to probably be successful.
Yeah,
Like, those are
you're
all the
gonna.
right things you should be doing. And then you've got connections, network, people giving you advice, someone to call when you're in trouble,
Mhm.
versus someone wrote a coaching plan for you and
And
put
and
their
you'll
foot
have
up your ass every month to say, go buy properties.
and you'll have such a broader range of knowledge and information from more people that have been there doing it rather than two or three people that run that one particular organization that are telling you what you want to hear or what they think you need to hear. It's particularly myopic, whereas this way it's so much broader. I think that's a way better plan, and by the end of that year, you're going to have a level of knowledge so much further ahead than somebody that spent the money going to a bunch of seminars and spending thousands of dollars a month for the privilege of doing that.
Well, and I
But
will say this because I have worked with many of the major real estate investing groups in Canada and dozens of smaller ones. And one is they all go heavy on enthusiasm. Two is I agree with probably 50% of what every group does. It's a different 50% with each. But then there's 25% where I'm like, well, that's situational. You can't give that advice to everybody. And then 25% of each of these groups' messages, and it's different for each group, I would say that probably I just blatantly disagree with.
Mhm.
You know, you have certain groups that just push burrs aggressively, others that push flipping, others that push raising capital in JV, others that push private lending. And it's important to know that all these different strategies are like tools: hammers, chisels, screwdrivers, drills. Well, if you're trying to build a house that is your financial future, you're not going to build the house with just a hammer. You don't just use a saw. You don't just use nails or screws. It's a combination of what's needed in the situation and what makes sense. So that's why I'm a believer of this more diverse connections and different perspectives is way better than getting into one specific group. And because let's be honest, they're political.
Yeah.
There's politics amongst the groups. They feud, they do all sorts of stuff. And it's not good or bad, but there's agendas and there's budgets and there's costs. Whereas if you just connect with people, I'm a believer that in a small level, all people are good. You know, there's really hardcore business people that are very what's in it for them. There's people that are bleeding hearts that will help. But odds are someone's not going to go out of their way to give you bad advice on an individual basis. They'll be real with you. But the moment you put someone on stage and there's politics and there's owners, and the messaging that someone can get out is often very narrow.
Yeah.
Because there's certain things you just don't talk about.
Yeah, it's a little more filtered then, for sure.
But
well, let's call it there for the day. I got to go race off and build a house with a saw just to prove you wrong.
I'll give you $100,000 if you can build a house with a saw, and that's it.
It's on like
This
Donkey
this
Kong.
this bet does not apply to anyone other than Jordan Spitters, because some actually intelligent person will go do it. But good luck, buddy.
All right, man. I'll see you tomorrow.
Cheers.